Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into Protect and Grow Chicagoland Retirement, your resource, ladies and gentlemen, for a common sense approach to your finance, your investment, and your retirement planning and future. Tim Stearns, CFP, is our resource here on the program. Always a pleasure to have you along for the ride, Tim. Thank you very much for being here and going to give us a hopefully a pulse of the market, the economy, and what investors should be thinking about or concerned about right now.
Well, Peter, I just got done reading a couple articles the other day that were saying that, about 50% of the people think it's going to be, the pundits, I'll call them, I think the market's going to be great. And the other 50% think it's going to be hell and high water. There's going to be a recession, et cetera. That being said, it reminds me back to 2008 when people said, my portfolio really took a hit. If I ever get back to where I was, I'll never do that again. I'll never take all the risks that I take. Well, then we go on a 13-year bull market, and you have people saying at the end of 2021, boy, this market's going to go on forever and ever. And then 2022 comes, and it's a reality check, right? Usually we have every 7 years, on average, there's a bear market, and we had a 13-year bull market. So people said at the end of the 2022, boy, if that happens again, I'm never going to do it. Well, guess what? We've made back a lot of those losses from last year. So I'm going to keep harping on the fact that I think there's a do-over out there. I think it allows us to take perspective of where we've been and where we are now, and to react to that and get ahead of it so that we're going to make our portfolios a little bit more active, more dynamic, maybe have some stop losses, maybe even not take as much risk. One of the things I harp on people in our retirement classes is you cannot invest like you're 40 anymore. You're down the runway here, that you want to keep what you've made, be smart out there. Get with a financial planner, get a plan, make sure that you understand what that plan entails, and just take care of what you've made, retain the gain, and that's huge, I think, out there right now.
Tim, the perspective is always the best from the top of the mountain. And that's just about where we are, it seems, right now. We've been up on peaks before and then fell down into valleys and troughs. And for the first half of this year, it seemed like all of the talk was about how 2023 was the coming recession that we are going to enter into. And yet 2023, at least thus far, has been a pretty fantastic year in the market. Good recoveries from the losses of 2022. But I hear what you're saying, and I agree that now may be the time to take stock, to really evaluate where we stand today. And if we want to go through that kind of market cycle and the up and down roller coaster now and moving into the future. And the question I sort of asked him is, do I feel like the next 10 to 20 years for our financial and market and economic stability is going to be as good as the last 10 to 20 years have been? We've had a fantastic run, but what's caused that, right? What's led and contributed, what's stimulated the economy, so to speak, has been a lot of government stimulus and quantitative easing after the Great Recession, and then the COVID stimulus. And is that truly sustainable for the next 10 to 20 years as we continue to try to make forward financial progress? So going to be talking a lot about that on the program today, ladies and gentlemen, and then what to do for your investing approach if we see that there is a need or a desire to make any kind of changes or alterations in the path forward. And Tim Stearns, certified financial planning professional, is the experienced, qualified advisor who can help you make those considerations and those decisions individually. And if you have questions or concerns, pick up the phone and give a call, 800-640-2256. That is 800-640-2256, 800-640-2256. Tim, throughout the program, we've been on almost 10 years here. You've had a theme of addressing what to do in periods of volatility or how to approach the risks that we do and in many cases should take with some money in the market. And I think that if we do take stock and evaluate where we are in the markets today, then we probably rightfully have a secondary consideration of, okay, now what do we do about where we are and how we feel about that?
Well, let's look at the market the last 6 months. You're looking at, 5 companies make up 24% of the S&P 500. Okay. You have AI that brought back NASDAQ from being near death last year, down 32%. And it's been, ripping this year based on AI, which still to this minute, people don't really understand it. We're not sure what it's going to do, what it can't do, what it shouldn't do, et cetera. That being said, the market to me feels a little soft and a fake out. And that's why I would tell people, take your winnings and be just a little smarter with it. Diversify into, non-correlated assets, things out there like annuities, cash value life insurance, things that would not react to the market going south when you've made back what you lost last year. Be smarter this time. You get a do-over. I'm going to keep harping on that because that's so important to me that people realize that they're not 40 anymore. They're baby boomers that are getting ready to retire or are retired. They have to make hay with what they have, right? Yep. And a lot of us don't have pensions. That's just another reason to have an income allocation plan with active money management.
Tim, you have also throughout the course of this program talked about a theme of correlated versus non-correlated assets. Sure. And I think that is an important consideration here as we look at the market and our prospects and outlook and expectations for the market into the future as well.
Well, let's talk about correlated. When I got into the industry in 1994, stocks went up, bonds went down. It was universal that was the case. Nowadays, last year, look at 2022, the market, the best index was the S&P 500 as far as being down. The least was down negative 18%. Then you had the bond aggregate was down 13%. So those are correlated. So what we used to go and run and hide when the market was bad, bonds, the flight to safety would be there. It's not safe anymore. So, and the Fed has already said that they're going to raise interest rates twice more this year. They have told us that. It's not an if, it's a when. So my point being is that what bonds react to is if the Fed raises their interest rates, bond values will go down. That's exactly what happened last year. And we've been calling that forever. So the stock market's a little more finicky. We'll see where that goes. But we do know that bonds will be hard. So what do? You need to find an alternative to that that's going to maybe throw off some income. There are great annuities right now that are throwing off amazing income. It's lock in, stock and barrel. It's a great opportunity right now.
I heard the comment recently, Tim, that income is on sale right now. That resonated. With the conversations we've had on this program, retirement is all about the dependable income that you can rely on. Quality of life in retirement is all about the dependability of the income that you can rely on. And to hear the statement that income is on sale right now is maybe something that retirees or pre-retirees should be paying attention to.
Right. It comes back to having a plan, right? Just trying to make it in the market by being a do-it-yourselfer or just having, I just went over a person's account the other day, their advisor, the client advised them, to go into lesser risky stocks. If you're paying someone to do their job, that doesn't make any sense when you have to do their job. So there's a lot of things going on out there. I would say a second set of eyes to look at what you have going on within your portfolio when you're back to even, let's call it that way. It's a great opportunity for that right now.
Again, if you have any questions, if you would like to look at what you can do to make sure that your portfolio is set up, is allocated in a way that is appropriate for today's conditions and moving forward into your financial future and progress, pick up the phone and give a call to TJ Stearns Inc., Tim Stearns CFP. Get that portfolio review, get that protect and grow plan that Tim and the team at TJ Stearns put together for their clients. No cost, no obligation for that document, that detailed plan, and the recommendations for the path forward to meet, match, and exceed your financial goals into the future. 800-640-2256, the number to call. 800-640-2256. 800-640-2256. Tim, you've also mentioned a couple times in this program already that we can't invest like we're 40 anymore. And as I reflected on that, the baby boomer generation is not 40 anymore. They are now making that transition into retirement. So Econ 101, supply and demand, when the wave of population, the baby boomers were 40, that was maybe the height of investment into the market. They're dumping money hand over fist, left and right, into their 401ks, which are now one of the biggest wealth tools and accounts that exist, an estimated $36 trillion of retirement money in those 401ks. Well, over the last 20, 35 years, supply and demand means that as people are buying things, prices would naturally go up. Well, as we make this transition to retirement, Tim, you talk about it all the time, we become net sellers of assets. That's a fundamental difference, not only in our lives, but in the demographics of the economy.
Well, you're looking at the end of the day, when you're done working, whatever is in your 401k, the only growth it's going to get is from the market. And last year, the market did not grow. And what were you doing as a retiree? You're taking money out. So you're a net seller of assets. So we have to make sure that we have a plan of where we're going to get our income so that we don't have to go into that growth bucket and lock in losses after we have earned all that money over our careers. The last thing you want to do is spend it down too fast, and I'm all for, enjoying yourself in retirement, but maybe last year you don't get to do that trip that you want to because the market's not cooperating. But if you have an income allocation plan for our clients, it didn't matter what happened last year because we had set aside money for the trips. We had set aside money for the utilities and the mortgages and whatever the what have yous that you live day in and day out, so that they weren't having to dive into their stock holdings, bond holdings, and take out money. That was absolutely huge to have a plan.
Again, we are talking with Tim Stearns, CFP, your certified financial planning professional resource. Ladies and gentlemen, Chicagoland, your resource to get that protect and grow plan put together. Pick up the phone, give a call, 800-640-2256, 800-640-2256. If you would like to get your own protect and grow plan. Tim, you've gone over reports and charts and data with us before on this program that showed how retirement has been structured for the last 30 or so years, following that 4% model, and how if that had been followed starting in the year 2000, we would have significantly less than our starting value today. Right? 20 years goes by and following that 4% rule with the real world returns of the market, you have significantly less than even half the starting balance just 20 years ago. And in looking at that and again, reflecting, my question is, at what point in time in my retirement am I going to be comfortable seeing half of my starting day one balance? Right? Is that 10 years, 15 years, 20 years? Is there any time in my retirement where I would be comfortable seeing that my account balance has drifted and declined so substantially? And I don't think there is a point in my retirement where I would be comfortable with that, which is why you really promote these approaches to volatility and income generation.
Right. And having uncorrelated assets that will prop up the portfolio if, God forbid, the market takes a correction like last year. I don't think people really have that in their portfolios. They say, well, didn't do well last year, I'll do better next year, hope for the best. That's not, hope is not a way to retire. You want to make sure that you have a rock solid, concrete idea of how a roadmap to retirement. And that's why we preach that in our classes. Anytime people, want to attend the class, they can do it via Zoom. They can do it in person. We're starting those back up in September. We'd love to have them. And it's $39 to attend the class with a spouse or a friend. That goes to Scholarships for America, for a charitable organization that gives scholarships for underprivileged children that want to go to college. I think it's a great opportunity to give something back and actually learn something. We're not there to sell products. We're not there to push anything, just to educate people. We cover Social Security, Medicare, more importantly, an income allocation plan to educate them, because I don't think a lot of people know exactly how to retire properly.
Well, if you would like to learn how to retire properly and optimally, pick up the phone, give Tim Stearns a call. You can find out when those upcoming classes are scheduled, where they're scheduled, find a convenient location for you, a spouse, a friend to attend. You can attend via Zoom, virtually, if you'd like. Or you can get the conversation started personally, individually about your specific plan with that complimentary review, retirement planning strategy session, and the Protect and Grow plan. Now, Tim Stearns' office, TJ Stearns Inc., is located conveniently in Arlington Heights, but you can meet there in person, or you can meet and consult with Tim, a certified financial planning professional, through the ease and convenience of virtual meeting and technology. Either is easy to get started. Just pick up the phone, give a call, 800-640-2256. That's 800-640-2256, or visit online, tjstearns.com, tjstearns.com, the website, and that's Stearns, EARNS, like Earns, tjstearns.com. Or 800-640-2256. It's easy to just lock that number in just on your cell phone right now as well. If you're driving, zooming, zipping around town, give a call, 800-640-2256. So Tim, on one hand, we've been told that risk is appropriate, and you've laid out some detailed rules or guidelines, if you will, for fundamentals of investment success for that part of our financial progress. But on the other side, we've also innately known that some amount of safety and protection is also very important. And that's really the second half of our financial lifespan that isn't as often discussed, I don't think.
Well, Peter, let's just go through some of the fundamentals of success in investing. And some of that is you want to make sure that you're paying attention. We have a lot of people who were with other advisors. They got pretty beat up last year, and they come in with unopened envelopes, right? Because they're scared to even look at where they've been, or they say, "Oh, I haven't logged into that in so long because I don't want to know how bad it was." After they open up those, or we go over them, next thing I would say is don't panic, remain calm. There is a way to fix this situation. And then another thing I would talk about is, by having an income allocation plan, you'll have accessible cash. Make sure you have that, so that you understand that you don't have to dip into your stocks while they're down, or your portfolios when they're down. Big thing about that is being informed. I think a lot of people don't understand exactly what the market it looks like. They're too used to a 13-year bull market, and what that does is just gives you a false sense of security. So that's some of the things that I would say are fundamentals. The other thing I would talk about is also reasons for safety now. Because again, we're talking about this do-over concept, right? We're where we were probably a year-ish and a half ago, right? Based on the fact that the market was pretty hot at the end of 2021, and then it went on the skids.
And people were feeling pretty good about the market a year and a half ago, Tim.
Right. And I had a professor who asked, he asked the class in our finance class, do you guys know how a bull market dies? And, we started trying to outthink him and give answers that we thought he'd want to hear. And he said, euphoria. And I think that's kind of where we were at the end of 2021. And now we're kind of, the market's back, right? But are we sure? Not really. Like I said, 50% of the pundits are saying that the market could go either which way. So I would say that make sure that you understand what your portfolio is doing and have your day-to-day expenses covered. That's one of the safe things that you can do, is by having a plan. Have that emergency account if you really get beat up in the market. But what that does by having a plan is it gives you comfort, right? So that you understand exactly where you're at, you don't panic, and you remain calm through this market that I think is going to be choppy through the end of the year.
Tim, there are a couple different types of protections financially as well that are all important in various portions of our total financial picture. I mean, we want to protect principal sometimes. We want to protect income, certainly, I think, into and throughout retirement. That's, again, what boils down to the quality of life that we will be able to confidently maintain in retirement.
Right. So how do you do principal protection? Well, I mean, no one wants to lose money, correct? But, we take that with a grain of salt when we go into the stock market. Well, how about looking at other areas? There are great vehicles out there like multi-year guaranteed annuities that are paying excellent returns. I'll give you an example. My mom had one that was 2.25 from 3 years ago, and she just locked in again at 4.65. No taxes, just rolled it over into the next version of it. 4.65% is pretty darn good. I don't think you'll see that for a long time. And then the other thing is just having income protection. There are great annuities. Like you said, income is on sale right now. The payouts that I'm seeing are just outstanding, and they're A+ rated companies. It's the real deal. It's not some come on from some company that you've never heard of. So those are the things that we're doing over here.
Well, again, we are talking with Tim Stearns, CFP, Chicagoland, your certified financial planning professional resource. If you would like to get that Protect and Grow plan put together, helping to optimize income, investments, taxes, healthcare, legacy, Social Security, if you've got questions about tax planning, how to manage the taxes on your retirement nest egg, about estate planning, Tim works hand in hand with professionals from all different aspects to make sure that all eyes are on your goals and that your plan is functioning from a tax, a financial, and a legal standpoint to achieve your goals. That's what the Protect and Grow plan is about. The balance of protection and growth is so vitally important, ladies and gentlemen. And now may be the best time, or as good a time as we have seen, to evaluate your balance and to put that plan together. That's why Tim Stearns is here as the resource. Give a call if you'd like to get that Protect and Grow plan. No cost, no obligation for listeners to this program for that opportunity. Similar plans, by the way, can easily go upwards of $1,000, several thousands, tens of thousands of dollars. We've seen them across the country. But Tim Stearns here in Chicagoland for proactive savers and investors makes this available to you. No cost, no obligation for being a listener to the program. Just call right now to get started. 800-640-2256. That's 800-640-2256. 800-640-2256. So Tim, during the first half of the program, the first half of the year, this year, we did hear a lot of talk about the coming recession. Do you think those fears are over? Can we put that behind us because the market has done so well for the first half of 2023? Or do we still need to be cognizant that that is a real possibility as we move forward?
You're talking about having a soft landing, and I don't know if that's really going to happen. So I would have an itchy trigger finger for the stock market to make sure that that you might not be able to do the buy and hold. Last year it lost $16 trillion with a T. So I would be I'd be very hesitant to put all my money in there. I'd also be very active if I was going to be trading to make sure that I don't just, ride the rails down again like I did last year, because, I feel like, people right now they have false confidence, in the market. And I think that they think that, it's easy money again. And I don't see that happening. I don't see the Fed printing more money like they did in 2021 to bring us back from the brink there with the pandemic. So let's be relative here and let's realize that we need to learn from our mistakes. Like in 2008, we should have seen that coming, with them giving out money, more than the property was worth. I mean, didn't you think that was going to end badly? So look at us now. What has changed? Not a lot. We have, the Fed is continuing to tighten the constraints here. They're not printing money like they did. And I tell people that all the time, that if they're opening up the spigots, well, you might want to enjoy the bull market. But if they're not, then you're going to have to be really careful about where you're at and where you invest in.
Yeah, Tim, I have to agree that stimulating our way out of economic downturns probably will be problematic more moving forward, since we've got in excess of $32 trillion in debt, and they've just come through this fierce spending cap debt limit debate, which, just narrowly at the last minute, kumbaya, they came together and agreed to continue spending even more money. But how much? Where is the limit to that? And relative. We've got to think about this relative. 2022 was a painful year for losses in the market, but in hindsight, retrospective, looking at 2000 through 2002, the markets lost more than 50%. And 2007 through 2008, the markets lost more than 50% again. And both of those took 5, 6, 7 years to get back to break even. We lost a good bit in COVID, but bumped right back up. We lost a good chunk in 2022, but generally, we've recovered nicely in a very short amount of time. But, is this going to continue and be sustainable? And you've talked about the fact that just buying, holding, and hoping is not the approach that investors should take.
No, it's not going to work. It doesn't work. We've shown people in the last 23 years, there's been 5 corrections, and how many times are you going to realize that, it doesn't work, the buy and hold. Why would you ride the rails all the way down to try to come back up the mountain? That doesn't make any sense to me. And I would tell you that I'm only 51. If I'm 61, I definitely believe that. I don't have a lot of time left to be making money, right? So if I'm towards the end there, I'm going to be a little bit more conservative, and I am definitely going to take care of that 59.5 loophole that you could take your money out and put it into something that might be stable, that might have stop losses. The other thing we talked about a couple of weeks ago is, not having stop losses on your portfolio is like driving your car blindfolded. And you can't do that right now.
Well, if you would like to get that protect and grow plan put together, pick up the phone, give Tim Stearns, CFP, a call, 800-640-2256, 800-640-2256, 800-640-2256, or visit tjstearns.com, tjstearns.com. Tim, always a pleasure to have you here on the program.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.